It's a pleasure to be here today for the latest in our Madison Trust webinar series. This is my first webinar with the company as I joined Madison over the summer. And, this is no BS. One of the first phone calls I made was to my friend Christian Catrone. We go way back with some previous employers that I was at. And anytime I come to a new company, I bring my friends with me. So excited to be here with Christian again. I want to stress, though, that the webinar today is strictly for your educational uses. We're not here to give any kind of tax, legal, or investment advice. We encourage you to do your own due diligence whenever doing any investments. Consult your CPA, tax advisors, attorneys to give yourself that confidence that the investment you do is the right one for you. So with that in mind, Christian, how you doing, my friend?
Good, man. Thanks for having me on. Really excited to just spend some time with you and just catch up. I know that you've had a chance to come visit Austin a couple times now, and we've been able to reconnect since you've been able to plant a flag there at Madison. And so
Yeah.
just excited about all the things that I've learned about your organization so far, and just really excited to share about what I've got going on alongside my buddy, my partner Manny here with ADP. And so we've got just some really great things to share. This is definitely intended to be more educational in nature. Any questions specific to our fund or anything like that, we're happy to answer. But for the most part, we're just excited to sort of climb the hill and yell from the rooftops about medical real estate and just this newfound niche within commercial real estate that not a lot of people know about, but we certainly know a lot about it based on my experience background, that of Manny as well, and the team that we've assembled. So excited to share all that today.
Look forward to it, man. And I know from my travels and my years in the industry that we are seeing an uptick in medical as an investment vehicle. But to your point and your background, and I'll let you speak to that, speak for yourself on that. But you've got a couple decades of experience in this. So it kind of gives you guys a bit of a leg up in that you're not new to the party. You've already well established and far ahead. So with that in mind, let's jump into some questions here. I want to make this interactive, and anybody that has questions that's watching this, please utilize the chat. We'll end this in about 35 minutes, and we'll address the questions then. But provide some background on both Redeem and American Development Partners with your friend Manny, and really what led to the decision for you guys to collaborate with each other on this endeavor.
Yeah, no, great question, Kurt. So I started Redeem back in 2017, and really the intent there was just to get into real estate because I had heard so much about it. I learned as a young kid, first generation immigrant, having been born in the Philippines and coming to the US, that real estate was one of the primary ways that people in this country had created wealth, or once they became wealthy, that they could then utilize their wealth to further it, to mitigate taxes, et cetera. And so it was something that I was intrigued by, sort of wanting to pursue the American dream, if you will. Um, my personal story, I was gifted athletically, academically, enough to get an appointment to West Point, which is where I went to school, served as an Army officer for a couple of years. But in the course of playing football for Army and being injured playing soldier, ended up incurring a lot of injuries. And it was those injuries that then prompted me to pursue a career in healthcare when I was medically discharged due to a knee injury. And then that's what parlayed into a 20-year healthcare career. Took a pit stop to get my MBA from UT Macombs Business School. But by and large, it was that healthcare experience that I'm now able to leverage with the experience that I gained doing commercial real estate for the last 8 years or so, and now combining them together in order to do medical real estate. And so, in the course of leveraging relationships with our veteran networks, we came across Manny, who was affiliated and associated with a veteran, a fellow veteran, who then introduced us and really immediately knew right away that there was something that we could do together. And it's really interesting how it's morphed and materialized. Really, the first opportunity we had was after we acquired on the Redeem side a medical real estate property in Texas. We had a vacant space there, and so we, after meeting with Manny and learning about ADP and all the things that they do, we approached them to see, hey, is this a space that one of your exclusive healthcare clients would be interested in? And literally within 24 hours, if not less, Manny came right back and said, hey, that's the ideal space. Those guys are wanting to expand a footprint in West Texas. They will take it. And so we worked through the lease structure very quickly. And within a matter of 2 weeks, we had an executed lease right before we closed on that property. which then boosted the value of that property from 6.5 million that we bought it for to 11.4 million. So I said, well, let's just rinse and repeat that, Manny. How can we do that again? And so we've now formalized our relationship by way of the launching of this new fund. And with this new fund, we're just looking to grow and scale these types of opportunities that we found together. So, Manny, with that, let me toss it over to you to introduce yourself and talk about ADP and just the amazing track record that you guys have.
Thank you for that, Christian, and thank you for everybody joining this webinar. So, I actually very blessed again. I came to the United States. I played professional hockey here, and when I was done, I had to go get a real job. And so, my real job was to go into, which is now American Development Partners, some 29 years later. American Development Partners wanted everything to do with single tenant development under one arena. So, we are a developer. We're a licensed general contractor in all 50 states, licensed architectural and engineering firm with our M card in all 50. We have in-house real estate, which then we engage local brokers across any state where our tenants want to go. We have what we call soft capital markets, which we syndicate a significant amount of money each year to help support our pipeline. We will break the 1,800 unit mark as a company. So we are a large volume, large volume single tenant developer that'll break the 18 unit mark as a company by the end of the year. So we've done an incredible amount of volume across the country. We currently have an accounting compilation valued at about $9.2 billion of pipeline. So we are a type of organization that when you have capital to place, or you can partner with a group like Redeem, who's an integrity-based partner that we can work with, we now have the full life cycle of single tenant development. We are a group that will only do large tail development, meaning we won't do onesies or twosies. When we go find a tenant, typically an emerging growth brand, they're a group that wants to go from 5, 10, 15 units. They've proven their model. They have some money on their balance sheet. They're profitable and they have an incredible management team. We'll then sign a development agreement after we do go through an underwriting process to bring them from where they're at to maybe 250, 300, 400 units across the country. So we are very focused on achieving a growth goal. This works perfectly for the type of fund that Redeem has allowed us to be a part of, which we're super honored to be part of, and a partnership with Christian and his team. So I'll turn it back to you, Christian.
Yeah, no, thanks, Manny. I'm sure Kurt will have some follow-up questions in terms of what does that look like in terms of the track record and things like that. But yeah, I wanted to share this screen real quick just to give some additional insights into what you guys have done and are doing at ADP. The value for us, Kurt, I think you know this, is if we can concentrate our efforts on all the things that are involved with running an investment firm already, and yet have a solid pipeline of deal flow because of the relationship we have with Manny, who's been charged to build, on the bottom left, 250 surgery centers and 300 med spas and so on. It helps us to be able to determine which of those deals are a good fit for our fund and to then do those deals together. And so we don't have a problem with deal flow at this point, in large part because of the relationships. There's other methods by which we source deals as well. However, man, this partnership with Manny and ADP is just one that we're blessed with. So,
Well, I think that's kind of a key differentiator when we look at track record meeting success is in our industry. We know this because we've been in it for a decade plus. The relationships are what win in the end. It's all about relationships and people that, to your point, there's a lot of operators out there that might be struggling with even deal flow. They might have an investor database lined up ready to go, but no deals. So when you can marry those two together, it makes life much simpler for everybody involved. And it just allows you to, as you said, you rinse and repeat because you've got that pipeline full.
And on that note, I think it's to your point, matching deals with capital is really the name of the game. We've had some good success with engaging with larger capital sources with family offices and things of late. But we also see the value of continuing to engage with individual investors because that's how we got to where we are now, which is why I'm excited to be on here with you and engage with anyone who might be interested from your audience about learning about these things some more and utilizing both qualified and non-qualified capital. So yeah, excited to just delve into that more and more.
I would say, as a follow-up to that, as we talk about differentiation and the relationship between Redeem and ADP being one of those, But if we drill down, what would you say are the aspects of the business model and the strategy in mind that
Yeah.
you guys have that would differentiate yourself from either established operators that are in that space, or more specifically and broadly, the new people coming into the space that are coming from notes, that are coming from storage, that are coming from apartments and multifamily? What would you say, beyond the relationship with ADP and the years that you have, what is it that really separates you from the competition? Because in the end, operators are kind of competing for the same dollars. So
Sure.
differentiation is a key point.
Yeah, let me we did a side-by-side comparison that I'd like to share with you here, Kurt. Hopefully you can see my screen here. Basically,
Yep.
looking at the different types of properties and different asset classes within commercial real estate that people can choose to invest in. We know a bit about each of these because we've experienced all of them. I mean, multifamily, it was sort of my first love in commercial real estate, if you will. She hurt my heart. She hurt my heart.
Like we were talking about yesterday, man, the industry and pro formas, they'll break your heart worse than any ex-girlfriend I've had.
I know it, but there are some really great operators out there. I have so much respect for those guys who have been able to build something special, vertically integrated, etc. The truth is that not everybody is in that segment of that space, and so there's a lot of exposure you have to these various different things listed on the left with regards to demand volatility and risks related to operating expenses and whether or not the tenants are credit worthy. I mean, uh, the short-term nature of the leases, et cetera, and the returns at this point and in this market cycle really being variable. You really don't know because little thing happened with interest rates and how much they spiked over a short period of time. You also have increasing cost of materials and labor that then impact your operating expenses. And forget about it when you have a capital improvement situation with capex. Those are all things that erode potential returns for investors, right? And in within each category, whether it's office or hospitality, those are affected by that in varying degrees. With regards to the final column on the right hand side, medical real estate, man, it's the type of tenants that we lease to are healthcare providers. First and foremost, that in itself provides lower underlying risk simply because of the demand among that segment, right? If someone has a toothache or a crown that they need or something, they're not going to go to the dentist. Like that, they will go, and we have data that shows that people are paying just as much out of pocket expense as insurance pays for dental care, right? So that just tells you that people don't skimp on their dental care. Surgery centers. Manny and I were looking over sort of the market research in Phoenix for the tenant out there that we're leasing to, and it's just tremendous opportunity within the surgery center space for lots of different reasons. But having the healthcare background that I have, as I mentioned earlier, helps us to determine what type of specialties are best conducive to having the type of stability that we like to have now with medical real estate. The leases are long-term in nature. Minimally, we like to have 10 years. The ones that Manny has been sourcing have been 20 or 30 years in length. There's such lower risk when you talk about credit worthy tenants that are healthcare providers. I mean, one of the ones that we have has a $65 million endowment behind them that's unencumbered. And should it be needed to cover rent or anything else, they have that to be able to draw upon. Not to mention a personal guarantor with over $100 million of net worth, the majority of which is liquid. And so the triple net leases I can talk about here in a moment, man, I love those and I can explain what that is. Many people don't fully understand what that means, but it certainly reduces risk for us on the landlord ownership side. And then, like I said, because of the income that we get from these properties, and when we match that, which is highly predictable, and when we match that with fixed rate debt that doesn't change month to month, what we end up having is a highly predictable stream of cash flow that then enables us to provide distributions to our investors. So all those things in combination is what to us makes it almost a non-comparison, if you will. Medical real estate is where it's at, and that's really where we're hanging our hat and pursuing to the next level.
You mentioned the triple net lease piece, and I know that that's a big one for you guys, as we discussed
Yeah.
it yesterday and in our previous discussions. Kind of explain the concept of the triple net lease and how it functions in commercial real estate.
Well, funny you should ask. There's a whole slide here that I've got prepared for this.
That's wild, huh?
Yeah, so first and foremost, there's a couple of different components or pillars to triple net leases. Number one is they're long-term in nature, at least the ones that we like to engage in. Typically, they can be single, double, triple net lease. The type and version we prefer is something called an absolute triple net lease. That implies that not only are the operating expenses covered by the tenant, not us as the landlord. In multifamily, we were responsible for that, for example. But anything related to capital improvements or capital expense, roof, HVAC, systemic, structural, or foundation, those any expenses related to that are entirely the responsibility of the tenant, right? So what that means is that we can then have reduced management responsibilities. I don't know if most folks know this, but when you go to like a CVS or a Walgreens store, those stores are typically absolute triple net lease. The owners of those stores may not have even been to that property in years, simply because it's the tenant's responsibility to maintain the landscaping and all the maintenance and repair and all of that stuff. We ourselves on the Redeem side like to be involved because we want to know what's going on with the buildings and have a record of and a log of different services that have been rendered. So that way we can pass that on to the buyer whenever we choose to exit. And then, like I said, this type of structure just provides much more predictable cash flow because we know exactly how much rent is coming in and they pay the rent. Unlike multifamily, we had tenants who did not pay rent. And then we also have, again, fixed rate debt in place. Typically, that's after any kind of a construction period so that the cash flow is more predictable. So something that I like to emphasize here, and this might be a good point to do it, Kurt, is that, investors have a range of different options when it comes to how they deploy capital. You can have sort of longer term development, and I've invested in those too, where for 3 or 4 years I shouldn't have expected any kind of a return, and potentially there's a really big return on the backside, but there was no cash flow in the interim, right? Those typically end up being a lot more risky just because there's a lot of things that can go wrong. Something like this, where we buy it and it's immediately cash flowing, is a much different proposition and one that folks ought to consider when they're looking at a balanced portfolio, right? Because now you can have sort of an income stream in addition to some upside appreciation, the tax benefits that come with real estate and that type of thing. And so while this doesn't provide sort of a moonshot opportunity where people are getting 4x, 5x, 10x their return or their capital, this is sort of not sexy, steady Eddie, just lower risk, lower underlying risk, lower variability, and just much more predictable. So that's the thing that these types of structures provide.
Well, I think in any market, but especially the one that we're experiencing right now, where yes, there is some market volatility. There's also some narrative volatility that's driving some of the fears that investors have. But to your point, where you said this isn't sexy, sometimes what's sexy is stable.
Yeah.
And when you can provide stable, predictable returns as an investor, which leads me into my next question, we kind of talked about factors of appeal for, say, for you on the operating side, but you're also an investor. So when you're talking with investors, what is it about the medical field, medical investments that make it appealing as an investor, whether it's using an IRA or their non-qualified money? What's driving them to you in this asset class?
Yeah, I think, and Manny, maybe you weigh in on this, but there's just a lot of demand. I mean, that's the first thing that I go to is anytime you're building something or you're buying something, the question is, what's the viability of this asset long term, and is there a demand for it, right? And so when we outline sort of the benefits of medical real estate, again, having strong and reliable healthcare tenants is paramount. I mean, that to me is much more important, almost almost more important than the physical condition of the building, because that's what I have Manny for. Manny, with what they do with ADP, like I don't have to worry, hey, can you refurbish or refresh or update or build this thing? I don't have to worry about that. What we do spend a lot of time doing is vetting and determining, okay, is this tenant uh, uh, credit worthy? Are they viable? What is their business model? What type of customers do they serve? Right. And we know, based on our experience within healthcare, which of those are the most likely to succeed and have demonstrated success. Long-term leases I talked about just a moment ago. And then here's the other thing, and again, I'll hand the mic to Manny here, but the cap rate differential piece can't be overlooked. That's really part of the way that we create the most value, because having a 2% year over year annual escalator, while it does compound, that's not the primary mechanism to create value. The primary mechanism to create value is being able to build at a or buy between an 8 and a 10 cap, and then uh, for properties that could readily and easily trade between a 6 and a 7 cap. So Manny, speak to that if you would, please.
No, first, you did a really good job. You brought up all the great points. A couple of things I'd add is one, under the single tenant model, one of the reasons why I think the relationship with ADP that complements what Redeem is bringing to the investor groups is there's also no risk for cost overruns. One of the things ADP guarantees on our balance sheet is something called a gross max clause. So if we draft a budget to Christian and it comes in at $3 million, and unfortunately the markets change, and then the final budget when we're in the field becomes 3.2 million, ADP absorbs the $200,000 overcost and overrun and never impacts your return. So I wanted to add that to your point, Christian. You did a great job at that. As far as market sector, ADP builds anything in the freestanding single tenant assets. We've done high performance go-kart tracks to pharmacies, every restaurant chain, health clubs, bar none. Our highest yield or return and the safest investment has been our medical retail, or we call medtail. Medical retail is the highest yielding return we put to market. It allows for, as we saw during during COVID, those are open and they don't close just because of some type of cycle that we're going through as a community, or obviously a global problem at that point. And it allows us to bring safe investments to the marketplace. When we look at the underwriting process, before it even comes back to Redeem, is we only look at assets that we can underwrite either at a yield of a 9 cap or a 10 cap, allowing our partners to have the yield between what we build and what they potentially could sell it at as that delta for a safety net, if you will, or a spread. So it allows us to have all the downside protection taken care of. It protects the gross investment, and single tenant medical is the largest acquired asset right now in the triple net space. We're going to do, it looks like this year, somewhere around 80 projects, and we have 0 products that are not pre-sold or committed. We're going into the end of Q4. We're projecting 22 new units to happen between now and December that all have contracts against them. So that just speaks to the demand, the volume in the 1031 or the publicly traded REIT that come to us for product. Christian, back to you, sir.
Yeah, no, thank you for that.
What do you touched on some of the strategies, but kind of generalized strategies that are used to manage or mitigate risk with this type of investment? When we're talking about kind of what investors are looking for, risk mitigation can be an indicator of stability and success within the investment. So kind of talk about what you guys do to mitigate the risk, not only for yourselves, but for the investors that are coming in with you.
Let me start off and I'll turn it back to Christian. We don't touch or start an asset without a fully executed, in this case, a 30-year triple net lease in hand. So when you're looking at this opportunity, people think, well, I'm buying real estate. You're investing in real estate, but the underlying support mechanism is a long-term stabilized lease by a credit-worthy tenant. And having that in hand before we move $1 is one of the risk mitigation tools we put in place. Secondarily, obviously, our volume and opportunity to bring this type of client to market allows for them to grow and continue to build their overall chain or their overall opportunity. So they're bringing a better balance sheet to the marketplace. And Christian, I'll let you finish that off. So
Yeah, no, that's a very good point. And the first thing that Manny hit on is something that's very important to us, because I'm just too chicken to close on anything without having a tenant in tow. Like, we just won't buy a building without knowing that we have a tenant lined up. Now, I will say this. I referenced earlier that we bought a property out in Abilene. This is sort of the case study for that, where we structured that such that even if we never leased that third unit, our investors still would have doubled their money within 5 years, right? Just with the 2 of 3 units occupied. Because we were able to lease that, and ADP's involvement in doing so, we were able to then get this higher valuation. But I didn't buy that building thinking that, hey, if I can lease this, then I can meet our investor objectives. Everything above and beyond that is exactly that, is it's gravy, right? So any other property though, we're not banking on the fact that we're going to be able to lease something up. Like, I need to know in advance, and we need to have that lease executed. Otherwise, we're just not going to close on that. And so the site, another risk mitigation thing for us is sort of applying how we go about selecting deals. If they don't meet our criteria, we'll simply pass on the deals, point blank. We like to buy properties at least at an 8 cap. So between that 8 and 10 is what we've been doing. It has to be medical real estate at this point in the game for us. And we also like to ensure that the lease rate that we negotiate is below market rate, so that we have it reduces sort of the lease mitigate or releasing risk, right? So if we're leasing below market and for some reason or another that tenant ends up blowing out, we know that with confidence that we can release that to another tenant, because we have rates that were below market. We also like to make sure that the properties are below replacement costs as much as possible. And then we also again review in pretty good detail the credit worthiness of those tenants. We look at the physical attributes of the building, its proximity, its geographic location, a lot of different aspects to it, just to ensure that this is going to be a good long-term investment on behalf of our investors.
I can appreciate that because it's very well rounded, you know, and I like a point that you made where it doesn't fit the parameters of what you buy, you're going to pass on it. And you're okay doing that. That speaks again to the point made at the beginning with the relationship with ADP. Deal flow is not the problem. It's not a problem with you, so you can pass on them. And I think that that can be a mistake that we see people make in the industry, is they get kind of a starvation where they find a deal and they feel like they got to take it. They have to take it because I got to have a deal.
Right.
The operators that are comfortable and confident enough to say no, doesn't fit our parameters, which means it doesn't fit the investor parameters either. I appreciate that you guys have that kind of diligence behind it, because you're not just looking out for your best interest, you're looking out for the best interest of the investor as well.
Right. Absolutely. I mean, that's really what it comes down to for us, is taking care of our investors. I mean, people trust us. They come alongside us to deploy capital that they've worked hard to earn. I mean, we don't take that responsibility lightly at all.
We'll touch on this point. I know that I don't have it as a question, but you and I talked about it yesterday. One of the backbones and kind of the heartbeat of Redeem are those philanthropic efforts.
Yeah.
Speak to that, because I think that when we have companies that, yes, they're successful. Yes, they're successful for themselves and their investors, but there's always that give back, that civic piece of it that I like. So speak to that if you can.
Well, let me start off by saying this. So there's 2 parts to that, and I'm really glad that you asked that question, Kurt. So the first thing is, we really feel like, just simply by nature of the type of properties that we're buying, that there's a social impact piece sort of built into that. Because for those who may not know, access to care, to healthcare, is an issue in America, almost as much as affordable housing and things like that that most people know about. So we feel like by partnering with healthcare operators, especially these emerging brands like Manny talked about, and help them grow and expand, we're able to then indirectly at least help increase access to care by way of our partnership as the real estate partner to these healthcare operators. In addition to that, and Manny and I have talked about this quite a bit, and something that's near and dear to both of our hearts is giving back, right? So we created something called the Redemption Foundation. And what we do is we give a portion of our profits from the GP side, not from the LP side, because we don't want to erode their returns. And we donate it to charities that are committed to suicide prevention. And so among those are the ones listed here, for example. And this was really an inspiration by a West Point classmate of mine, Brad Hunstable, who's on our advisory board. His son sadly committed suicide during COVID. His name was Hayden. And so you see Hayden's Corner here. I just actually attended their annual gala in his honor up in Fort Worth a couple weeks ago. But in addition to that, we have other ones that are focused on suicide, or I'm sorry, veteran specific ones. So you see Mission 22, Stop Soldier Suicide. Sadly, there's just highly prevalent among veterans, suicide is. And so that's something that we aim to impact. I was also connected by Brad to Dak Prescott's foundation called Faith Fight Finish Foundation. And the executive director for that also is the executive director for Matthew McConaughey's foundation called Just Keep Living. In fact, I'm speaking at a local high school here in Austin tomorrow on their behalf, just to encourage those kids and just talk about life. And so I'm really excited to go do that. But yeah, this is something that we do. We don't mandate that our LPs come alongside us and donate, but we do include a QR code here on the right, top right, for those in the community that want to partner with us and also donate money to causes like this. So this is a vital piece of our fund and something that we're excited to incorporate this time.
Christian and Kurt, maybe
I,
to round it out here, just one thing that Christian never says, and he's so humble. And, ADP has been, we have money offered to us all the time because of our volume. We're a preferred developer for all the big publicly traded single tenant REITs. We will deal with some of the super high net worth family offices across the country. We had options, and we agreed and chose to be partners with Redeem because of their integrity, because of their give back mentality, because of their commitment to their investors. These are things after you've done 1,800 units as a company, you start looking and say, these are the type of people I want to be next to. And so again, Christian doesn't always toot his own horn, but he leads an amazing organization, and we're honored to be part of this kind of growth strategy.
Appreciate that.
Well said, Manny. And it reminds me of a quote of one of my personal heroes who shall remain nameless, but it's in the spirit of the saying, if you want to keep what you have to be willing to give it away. Mm. And when we were talking about this yesterday in our previous conversations, Christian, that quote was resonating with me because it's an appreciation of what the real mission is. I appreciate you a lot, Manny. Thank you as well. And Christian, I'll be in Austin in a couple weeks, so we'll get to hang out a little bit.
Sounds good. Thank you guys for the opportunity. On behalf of Manny, myself, Redeem, and ADP, we're grateful for the opportunity and happy to help anybody who's interested.